Here is something most Canadians do not know. The Canada Pension Plan Investment Board, one of the largest and most sophisticated institutional investors in the world, manages over $600 billion in assets. Its investment team includes hundreds of analysts, economists, and portfolio managers with decades of experience. The Ontario Teachers' Pension Plan manages over $250 billion. Same story. World-class team, enormous resources, decades of institutional expertise. And here is the part that should stop you. The core of what both institutions do: diversify across thousands of companies globally, minimize fees, stay invested through market cycles, and capture long-run equity returns, is available to any Canadian with $500 and a Questrade or Wealthsimple account. Not a version of it. Not a watered-down retail equivalent. The exact same underlying market exposure, at fees that are a fraction of a percent per year. The vehicle is the Exchange-Traded Fund, the ETF. And in this video, we are going to cover the 5 ETFs that every Canadian investor should know about. What each one holds, what each one costs, what each one has returned, and exactly which type of Canadian investor each one is built for. By the end of this video, you will know more about low-cost ETF investing than most Canadians who have been investing for decades. XEQT, the iShares Core Equity ETF portfolio, is a single-ticket, all-equity ETF that gives Canadian investors exposure to approximately 9,000 companies across global equity markets. It is managed by BlackRock Canada and trades on the Toronto Stock Exchange. What it holds: XEQT is structured as a fund of funds, meaning it holds 4 underlying iShares ETFs that together cover the entire global equity market. Core S&P Total, U.S. Market ETF, approximately 45% of the portfolio, U.S. equities. Core MSCI ETF, approximately 24%, developed international markets, Europe, Australia, Asia. Core Capped Composite ETF, approximately 25%, Canadian equities. Emerging Markets, IMIETF, approximately 6%, emerging markets. The result: owning XEQT means owning a proportional slice of thousands of the world's publicly traded companies, from Apple and Microsoft to Royal Bank and Shopify to Toyota and Nestlé, in a single daily trade. What it costs: management expense ratio, 0.20% per year. On $10,000 invested, that is $20 per year. On $100,000, $200 per year. The average Canadian actively managed mutual fund charges approximately 2.0% to 2.5%, 10 to 12 times more. What it has returned: XEQT launched in August 2019. Since inception to early 2026, XEQT has delivered approximately 10% to 11% annualized total return in Canadian dollars terms. In 2023, up approximately 19%. In 2024, up approximately 22%. Who it is for? XEQT is designed for investors with a long time horizon, ideally 10 years or more, who want maximum global equity exposure, are comfortable with short-term volatility, and want a single holding that requires no rebalancing and no additional decisions. A 28-year-old Canadian investing $7,000 per year in XEQT inside a TFSA from today to age 65 at a 9% annualized return accumulates approximately $2,100,000 tax-free. Canadian application: XEQT is the most commonly recommended single ETF solution for Canadian investors who want to apply the index investing principles of John Bogle applied globally at minimum cost. It is the implementation of own the world, pay almost nothing, stay invested. Your action step: look up XEQT on the Toronto Stock Exchange today. Check the current unit price. Then calculate how many units your next TFSA contribution would buy. That is your starting point. VFV, the Vanguard S&P 500 Index ETF, tracks the S&P 500 Index, which represents 500 of the largest publicly traded companies in the United States. It trades on the Toronto Stock Exchange in Canadian dollars, managed by Vanguard Canada. What it holds: the S&P 500 includes companies like Apple, Microsoft, Nvidia, Amazon, Alphabet, Google, Meta, Berkshire Hathaway, J.P. Morgan Chase, and Johnson & Johnson. It covers approximately 80% of the total U.S. equity market by market capitalization, and the U.S. equity market represents approximately 60% of the entire global equity market. In short, owning VFV means owning the engine of the global economy. What it costs: management expense ratio, 0.09% per year. On $10,000 invested, that is $9 per year. VFV is one of the lowest-cost ETFs available to Canadian investors. At 0.09%, the fee is so small it is almost irrelevant to long-term returns. What it has returned: the S&P 500 has delivered an average annualized return of approximately 10.5% per year over the last 30 years in USD terms. In CAD terms, VFV has also benefited from periods of CAD weakness relative to the USD, adding currency translation gains on top of the underlying equity return. In 2023, VFV returned approximately 24% in Canadian dollars. In 2024, approximately 27% in Canadian dollars. The S&P 500 has had only 6 negative calendar years since 1980. Who it is for? VFV is for Canadian investors who want concentrated exposure to U.S. equities, the highest returning major equity market over the last several decades, with maximum simplicity and minimum cost. It is also for investors who already have Canadian equity exposure through work pension plans, Canadian dividend stocks, or real estate, and want their TFSA or RRSP tilted toward the U.S. market to balance their overall exposure. The currency consideration: VFV is denominated in Canadian dollars, but tracks U.S. equity prices in U.S. dollars. When the Canadian dollar weakens relative to the U.S. dollar, VFV's returns in Canadian dollars terms increase. When the Canadian dollar strengthens, they decrease. In April 2026, with the BOC Fed rate differential at approximately 2 percentage points in the U.S.'s favor, the CAD is under pressure, which has been a tailwind for VFV holders. Your action step: look up the 10-year return of the S&P 500 index. Then compare it to the 10-year return of the average Canadian equity mutual fund. That comparison tells you everything you need to know about why VFV belongs in most Canadian TFSAs. VDY, the Vanguard FTSE Canadian High Dividend Yield Index ETF, tracks an index of Canadian companies with above-average dividend yields. It trades on the Toronto Stock Exchange in Canadian dollars and pays distributions monthly. What it holds: VDY is heavily concentrated in 3 sectors that dominate Canadian dividend culture: Canadian banks, Royal Bank, TD, Scotiabank, BMO, CIBC, National Bank. Approximately 55% to 60% of the fund. Canadian Energy, Enbridge, TC Energy, Canadian Natural Resources, Suncor. approximately 20% to 25%. Telecoms and utilities, BCE, TELUS, Fortis, approximately 10% to 15%. These are Canada's most mature cash-generative businesses. They have paid dividends through recessions, financial crises, and rate cycles consistently. What it costs: management expense ratio, 0.22% per year. What it pays: VDY's distribution yield as of early 2026 is approximately 4.2% to 4.5% annually, paid monthly. On $100,000 invested, that is approximately $4,200 to $4,500 in annual dividend income deposited into your account every month. Inside a TFSA, that dividend income is completely tax-free. Outside a TFSA, eligible Canadian dividends receive the dividend tax credit, making them among the most tax-efficient forms of income available to Canadian investors. What it has returned: VDY's total return, combining price appreciation and dividend reinvestment, has averaged approximately 8% to 9% per year over the last 5 years. In 2024, VDY returned approximately 19% total return, including dividends. The DRIP power, when held inside a TFSA with DRIP enabled, every monthly dividend automatically purchases more VDY units. Those new units generate their own dividends. The dividend snowball grows without any additional contributions required. Who it is for? VDY is for Canadian investors who want regular income, either now or in retirement, from a portfolio of Canada's most established dividend-paying companies. It is also for investors who want Canadian equity exposure with a value tilt and a built-in income stream. Your action step: calculate what VDY's current yield would pay annually on your target investment amount. Then calculate what that same amount would grow to over 20 years with DRIP reinvestment at 8%. The second number is typically 3 to 4 times the first, which illustrates why reinvestment is more powerful than taking the income. ZAG, the BMO, Aggregate Bond Index ETF, tracks the FTSE Canada Universe Bond Index, which represents the broad Canadian investment-grade bond market. It is managed by BMO Asset Management and trades on the Toronto Stock Exchange. What it holds: ZAG holds a diversified portfolio of Canadian government bonds, federal and provincial, and investment-grade corporate bonds. The portfolio includes hundreds of individual bond positions with varying maturities, providing broad exposure to the Canadian fixed-income market. Approximately 70% to 75% of ZAG's holdings are government bonds, among the safest fixed-income instruments in the world. The remainder is investment-grade corporate bonds from companies like Canadian banks and major Canadian corporations. What it costs: management expense ratio, 0.09% per year. What it pays: ZAG distributes interest income monthly. As of early 2026, with the Bank of Canada rate at 2.25%, ZAG's yield to maturity is approximately 3.5% to 4.0%. This reflects the improvement from the near-zero yield environment of 2020 to 2021, but is below the 5% plus yields available during the 2023 peak. What it does for a portfolio: bonds and equities have historically moved in opposite directions during periods of market stress, providing a cushioning effect when equity markets fall sharply. In a portfolio that combines ZAG with XEQT or VFV, ZAG acts as a shock absorber. When equities fall 20%, ZAG typically rises or holds its value. This is the primary reason ZAG belongs in a portfolio, not for return maximization, but for volatility reduction in investors who need stability, whether because they are closer to retirement, have a lower risk tolerance, or are drawing from the portfolio. Who it is for? ZAG is for Canadian investors in or approaching retirement who need their portfolio to be less volatile than an all-equity allocation. It is also for investors who want to reduce drawdown risk, the risk of their portfolio falling sharply at the wrong time, without moving entirely to cash or GICs. For younger investors with a long-time horizon, ZAG is generally not the right primary holding. The historical long-run return of bonds is significantly below equities, but as a stabilizer for 10% to 40% of a portfolio, depending on age and risk tolerance, it plays an important role. Your action step. Determine what percentage of your portfolio should be in bonds based on your time horizon and risk tolerance. A common starting rule: your bond allocation percentage equals your age minus 20. A 45-year-old, approximately 25% ZAG, 75% XEQT, or VFV. VBAL, the Vanguard Balanced ETF portfolio, is a single-ticket, all-in-one balanced ETF that holds approximately 60% global equities and 40% Canadian and global bonds. It is managed by Vanguard Canada and trades on the Toronto Stock Exchange. What it holds: VBAL is a fund of funds combining 7 underlying Vanguard ETFs into one balanced portfolio. Global equities, 60%, split across U.S., international developed, Canadian, and emerging market equities. Fixed income, 40%, split across Canadian aggregate bonds, U.S. aggregate bonds, and global ex-U.S. bonds. The result is a fully diversified, globally balanced portfolio in a single ticker, with automatic rebalancing built in. When equities run up and the allocation drifts above 60%, VBAL automatically rebalances back to 60-40 without any action required from the investor. What it costs: management expense ratio, 0.24% per year. What it has returned: VBAL has delivered approximately 6% to 7% annualized total return since inception, lower than a pure equity ETF like XEQT because the 40% bond allocation acts as a drag on returns during equity bull markets, but significantly less volatile with shallower drawdowns during market corrections. Who it is for: VBAL is the ideal starting point for 3 types of Canadian investors. First, new investors who are not yet sure how much risk they can tolerate. VBAL's built-in balance between equities and bonds means a market crash produces a smaller portfolio drop, which helps new investors stay invested rather than panic selling. Second, investors who want a completely hands-off portfolio. VBAL rebalances automatically, requires 0 maintenance, 1 ticker, 1 annual contribution, done. Third, conservative investors in or near retirement who want continued equity exposure but with a meaningful bond allocation providing stability and income. VBAL versus XEQT, the core trade-off: $10,000 invested in VBAL for 30 years at 6.5% annualized, approximately $66,000. $10,000 invested in XEQT for 30 years at 9% annualized, approximately $132,000. The difference, $66,000, is the cost of the stability VBAL provides. Whether that cost is worth it depends entirely on whether you would have stayed invested in XEQT through a 30% market correction. If you would have sold, VBAL's lower return is the better outcome. If you would have held, XEQT's higher return wins. Your action step. Ask yourself honestly, if your portfolio dropped 30% in 1 year, would you sell, hold, or buy more? Your answer to that question determines whether VBAL or XEQT belongs in your TFSA. Let's come back to where we started. The Canada Pension Plan Investment Board, the Ontario Teachers' Pension Plan, two of the most sophisticated institutional investors in the world. Their core strategy: diversify across thousands of companies globally, minimize fees, stay invested through market cycles, and capture long-run equity returns. You now have 5 tools that implement exactly that strategy, available on the Toronto Stock Exchange inside your TFSA starting today. XEQT, for the Canadian who wants the entire global equity market in one ticker. Long time horizon, maximum growth. VFV, for the Canadian who wants concentrated U.S. equity exposure at the lowest possible fee. Already has Canadian exposure elsewhere. VDY, for the Canadian who wants monthly income from Canada's most established dividend payers. DRIP enabled inside a TFSA. ZAG, for the Canadian who needs stability and income, approaching retirement, lower risk tolerance. VBAL, for the Canadian who wants a complete, balanced, hands-off portfolio in a single ticker. New investors, busy professionals, conservative near retirees. You do not need all 5. Most Canadians need 1 or 2, matched to their age, time horizon, and risk tolerance. But you do need to start, because the one thing every institutional investor, every legendary portfolio manager, and every financially literate Canadian agrees on is that the biggest cost in investing is not fees, not market timing, not fund selection. It is not starting. Open the account, pick the ETF, set up the automatic purchase, and let compound interest do what it has always done. Turn small, consistent decisions into life-changing wealth.